And what do I mean when I say buying the dips? I mean when a specific investment or investment vehicle or the market as a whole takes a dive, when it dips, right? When there's a certain amount of dip, then you jump in and you invest. You buy the dips. Now, this is something that seems extremely scary for a lot of people, right? Buying the dips is a scary proposition. Why? Because typically when there are dips, there is panic. And when there's panic, everybody is telling you that things are only going to get worse and things are bad, and that investing is not a good idea and you should put your money in this or that or whatever to save your principal or whatever it may be. But those are exactly the times when investing is the most profitable. Like Warren Buffett has said, and I've quoted it to you many times, be fearful when others are greedy and greedy when others are fearful. So basically saying when the market is real high and everybody's getting real greedy, then that's when you're most likely to have some type of pullback. Or when there's a pullback occurring and everybody's selling, that's when you can likely make some profits because you can buy things at a cheaper price. Well, that's exactly what we want to do when we are quote unquote buying the dips, right? When we are buying the dips, we want to buy things at a cheaper price and be able to profit on them over the long term, right? It's the idea of things falling in price in an irrational way, right? In a way that is more than what they should be falling in price if they were to maintain some potential intrinsic value, some value that that particular company is worth or that particular investment vehicle is worth. They fall below whatever price that may be, and then it is time to buy, right? There's a lot of value to be found in that investment. There's a lot of value to be found in buying those dips. So we're going to talk about why it's important that you do this, regardless of if you're putting money in systematically or doing the lump sum method, that you should still be buying the dips regardless. Now, people who are using the dollar cost average method probably don't care a whole lot about buying dips because their whole ideology is, hey, I'm going to buy it when it's high and I'm going to buy it when it's low, and I'm just going to be able to make money regardless, right? And that's perfectly fine. I subscribe much to the same ideas, and that's perfectly fine for you to do, right? My wife has a 401k that we systematically put money away in. We have IRAs that we systematically put money away in. I understand the idea of dollar cost averaging and not caring. But there are also going to be times, there are going to be opportunities that you can take advantage of where you can choose to purchase something that is on sale, right? You can buy something that is cheap relative to its intrinsic value, and you can make a lot of profit on the back end. I'll give you a perfect example, and it is a very new example, and it can be useful to you, hopefully, and be indicative of what you may choose to do in the future. Last year, 2020, right, when the market fell because of the coronavirus, and it fell violently, it fell over 30%, I knew the history of the market. Right? And this is extremely important to buying the dips in a proper manner. You have to know history. You have to know and understand what you're invested in. But I understand the history of the market. I understand what the S&P 500 has done historically, how much it has fallen given certain circumstances and things of the like. The market starts to fall, and it starts to fall in a precipitous way. It falls very aggressively. And it was scary, undoubtedly, because the value of your investments day after day is cratering. And you want to make sure that you can come out ahead in some way. Well, the only way to really come out ahead is to either sell before any of this happens, which means that you are a visionary and you can time the market perfectly, which is dang near impossible, right? Or you wait till things fall enough in value and you purchase them cheap. That way, when they increase in value, you can make money on that increase in value. And so that's what I chose to do. That's what me and my wife chose to do. I knew that if the market had fallen 30% or more, there was either not a lot of space left to go downward, right? Even though the market has fallen as much as 55% in the past, but either there wasn't a lot more room on the downside, or even if there was that 55% drop, things rebound extremely quickly. And if you can get something at a 30% discount, that seems like a pretty good deal. So last year, I bought, right? We bought a large amount out of money that was in savings, and we put it into the S&P 500. And since then, that money has made over 60% in returns. And it's because we bought the dips. We bought extremely low. Now, that is a huge example of buying the dips, right? That's a big example. That's the market fell hard. That is you don't get many opportunities like this to buy the dips, but there are more subtle ways to buy the dips as well. But what you need to understand is you can buy the dips on a broader market scale if you just pay attention. If you just pay attention to what the market is running at as far as like the PE ratio, right? We've talked before about the PE ratio being price to earnings, and as it is higher, that means that valuations are higher and that things are trading very expensively. Well, if you can find the market cheaper relative to what it is typically trading at, then you can purchase things at a dip and be able to ride them up towards the higher valuations. And that is a valuable thing to do. Or if you just understand how much the market has fallen in the past and what it should do moving forward, like I was talking about a moment ago, you should be able to do this in an effective way as well. And it absolutely does not matter if you're a dollar cost averager or a lump sum investor. If you see things occurring, especially in the broader market, that you can take advantage of in these ways, why would you not do it? Why would you not decide that if something is extremely profitable and I have money sitting on the sidelines that I can invest, that I can put to work, why would you not put that money to work? Even if you're a dollar cost averager and the market falls 30% and you're still dollar cost averaging, well, let's say you've got a little bit in savings that you're like, hey, I could put this money to work, I could invest this money, and you could do so, and you could do so at some handsome profits into the future. And what buying the dips is going to allow you to do is to have a higher overall rate of return over the long term. If you buy the dips consistently, especially the big dips, and let's say you continue to dollar cost average, then you will make higher returns than the typical dollar cost averager over the long term, because not only did you buy high and buy low and just get the average return over time, you also bought when things plunged, and you can get some of the highest returns when you buy things extremely cheap. And that's the whole idea. That's the whole idea of being able to buy a dip.